Good afternoon. Bruce Youngblood, Pension Solutions Canada.com. Bond yields are up. Like, should you care? Well, the answer is yes. So, what are bond yields? Why do we care? And I'm reading from my notes. And what can we do? Well, what is bond yields? So, bond yields, picture yourself as an actuary. Tom comes to you and says, here's my pension document. You're going to pay me $40,000 a year till I turn 65, and then you're going to pay me $25,000 until I die. And I don't know when I'm going to die. So how much cash does a pension plan have to put aside to pay that? And, the spouse or partner, if the member dies first, it's some number. And back, 2 years ago, those numbers were very large because, they were $750,000 and north thereof, because the bond yield was down to half a point, 0.5%. Today, it's 3%, let's say, for argument's sake. So bond yields, bond rates, what is this? Well, imagine you're the government of Canada and you need $10 billion. You go to the market and you say, right, what do I have to pay? They say, well, we're going to need a yield. We're going to need you to pay us 3% per year, each and every 10 year on a 10-year bond. So 3%. So that's the yield. If you're the lender, you're the guy with the dough, you say, well, what's my yield? How much money am I going to make? So there's your 3%. The bond rate is the same. I mean, you might say, well, what's the return on a bond? Well, the rate, the yield, the return, 3%. They all mean the same thing. So that's what that is. And we just follow the 10-year Government of Canada bond yield. Look it up on Google. You can see the chart. It's way down. Now it's, back up. So secondly, why do we care? Well, if you're taking a commuted value, you definitely care. 2 years ago, rates were low, yields were low, return was low, commuted value was up, as I said. So the converse is happening now. The rates have gone up, and it's a teeter-totter. Let me get a teeter-totter out here. So when, let's get this straight now. When yields are going up, look at the other end of the teeter-totter. They're going down. So bond yields are up, commuted value goes down. It's a teeter-totter. So I've had people say to me, oh, my commuted value is down by $200,000. Yeah, that's right. Because the actuary looks at it and says, I don't need to give this guy so much money. We can pay him out, on $500,000 and $550,000. We'll pay him out for his lifetime, whatever that may be. And it's just a mortality table. Take the average. Guys can live to 82 on average. Women are going to live to 87 on average. Do the math. Anyway, that's why we care, because the yield goes up, commuted value goes down. Okay. Now let's get a little microscopic here. Let's say you retired yesterday. So yesterday, the actuary did the calculation. You're going to get paid your pension out over to the end of your lifetime. And the actuary says, right, your company actuary says, right, for round numbers, let's say, I need $500,000. So then you get your paperwork 2 weeks later and you send it over to us. We send it to the insurance companies. If the bond yield has not changed, then the actuary at the insurance company looks at it and says, gosh, we need $500,000 more or less. Yeah, we can offer this pension, but there's no cash surplus. So that's in a 21-day, that's in a 3-week space. And you have 60 days, in most cases, to get these papers back. So you've got a little time. So that's scenario A. Now, so scenario B, your company actuary says $500,000. The paperwork's getting done, and the bond yields jumped from 3 to 3.25 to 350. 3 to 3.3 is a 10% jump. Now the paperwork lands at our insurance company actuary. She says, gee, bond yields are up. Do the calculation. I only need $450,000. Here's $50,000 left for you, which is taxable cash, by the way, just like income. So I use that to illustrate that if in that 2, 3, 4, 6, 8 week period, the yield is up, the required commuted value to write this pension drops, and there's extra cash in there for you. And I would reiterate, normally you have 60 days to get your paperwork back. If you're on the fence, as many people are, I don't care. I'll just take the company pension. I'll take the copycat if there's money in there. Well, why not wait to day 59, so to speak? Because this bond yield, look at it on Google, which is the one I use, 10-year Government of Canada bond yield. Have a look at the chart, and don't just look at it one day. Stretch it out to 6 months. Stretch it out beyond that. So, thirdly, what can we do? How's my time? What can we do? Nothing. Bruce, which way are the bond yields going? Which way are the interest rates going? Ask your bank where the GIC rates are going to be in 3 months, 6 months, 12 months, 3 years. You can't predict it. So what can you do? Well, in theory, you could say, gee, the bond yields are very high today. I'm not going to retire. I'm going to delay my retirement by a month, 3 months, 6 months, a year, until that bond yield drops. My commuted value will be up, and I'll get more money. That sounds nice in theory, but it is like, predicting a horse race. It is, you're trying to predict interest rates. It's very difficult. So there's not an awful lot that you can do. And surprisingly, let me say this: if you're taking the commuted value, yes, you want that commuted value number very high, yields low, rate commuted value high. If you're taking a copycat, you really don't care. You really don't care. 2 years ago, there was a lot more money on the table, and that's what was required at prevailing bond rates to pay out the pension. Today, sure, commuted value is down, but the company still has to pay you the pension. The actuary does the calculation, requires less capital, less cash, less commuted value. They still have to pay you the pension. It's not as if the pension drops because the bond yield went up. No, they still have to pay the pension. And the same is true of the insurance company. So just to restate that, commuted value, you want it as high as possible. Obviously, it's money in your pocket, so low bond yields are great. Copycat, other than that microcosm of 21 days, 3, 4, 6, 8 weeks, it has no impact. Yes, it'll have an impact on the cash surplus, but it doesn't really matter to you whether you get 750,000 or 550,000. The important thing is that the insurance company can write that. And rates dropped an awful lot in January, and we're having trouble. We're getting them written, but they're pretty skinny. So we'll see where rates go on a go forward. Anyway, I'm going to sign off. So just to go over that, we're talking about commuted values and copycat pensions, copycat annuities, mirror annuities, all the same thing. In our practice, we also like to integrate talk of Canada Pension Plan and Old Age Security. So I invite you to go on our website, pensionsolutionscanada.com, pensionsolutionscanada.com. I'm Bruce Youngblood. I'm a certified financial planner and a Canadian investment manager, as you can see behind me. Book, there'll be a pop-up with my pretty face, pop-up 15-minute Zoom. I'm happy to talk to you for 15 minutes, see what your story is, see what your challenges are, and see if we can work together. So thanks for watching. It's pensionsolutionscanada.com. Head on over to the website and hope to see you. Thank you. Have a great day.